2024, but we're going to basically talk about what happened last year. Some disclosures here. Cetera is our broker dealer, so basically these are all of my opinions and not Cetera's. And then we'll be using a lot of information that's going to be coming from Morningstar, and we use Morningstar for they're a very important partner for us, and we get a lot of information from them. So one of the important takeaways here, I think, is I'm going to be talking about indices, indexes, and it's not possible to invest directly into an index. Also, I wanted to let you know the questions, I do welcome those because if you're thinking about something, you have a question, there's a good chance that somebody else might be thinking that too. We've got people all the way down in South America joining us today, so who knows what kind of questions they could come up with. So, investment market update. I mean, last year was a really good year because we were really essentially recovering from a really bad year. If you look at this big downturn here from 22, that was a pretty massive drop there. And then 2023, we had a pretty good recovery from that. So the year turned out to be pretty good with it up 24% for the S&P 500. But remember, we really were just, if you look back for the last 2 years, we're really just kind of getting back to where we were. Going back even further, you can see the COVID big V-shaped recovery there. We spent a lot of money in the PPP and paying people not to work, and so that caused a lot of inflation later on, and then that started the round of interest rate hikes, which we'll talk about more. But as always, one of the main drivers of the market is going to be earnings per share, and these are one of the issues that's coming up because higher interest rates are going to directly cut into earnings. And that's why we've had a lot of volatility in the last couple of years. But you can see earnings are still up there, and there's no reason to believe that earnings are going to be dropping off anytime soon. So that's something that we continue to watch. But of course, if we look back here, this is essentially stock and bond annual returns. So the blue is the S&P 500, and the red is the U.S. Bloomberg bond aggregate. So you can see that generally you'll have either years where both are up or one is up more than the other. Generally, stocks are going to be up more than bonds, and you can see that there are years when stocks are down but bonds are up, and that is really nice to have a balanced portfolio. What happened in 2023, though, was we had bonds and stocks that dropped significantly. Stocks dropped significantly because interest rates are on the way up, and bonds dropped significantly for exactly the same reason. Interest rates were rising, and they were rising pretty dramatically. And interest rates and bonds have sort of an adverse or a contrary relationship. So as bond prices or yields go up or interest rates go up, bond prices will go down. And if you think of it this way, if you own a bond and it's paying 4%, and then all of a sudden now interest rates are at 5%, and you could easily go buy a bond for 5%, why would anybody want to buy your bond that's paying 4%? So your bond is going to go down in value so that the interest rate value equates to that 5%. So that's why the value of the bonds dropped. And this was a big problem for banks during that period of time. We saw 4 of the 5 largest bank failures in American history occur in 2023. So you probably remember the FDIC bailed all those guys out, and now the FDIC limit is unlimited as far as I can tell. Asset classes, this is best to worst from 2006 to 2023. And you can see that you have emerging markets is one asset class, fixed income bonds, that's a different asset class. Europe, that's a different asset class. The United States, that's a different, commodities are different. So if you look at the balanced fund, you can see that it's never at the top, it's never at the bottom, but it's kind of along the middle. And most of the years, the balanced fund will eke out a positive return. That was not the case in 2008 when almost everything was negative, or was it the case in 2022 when almost everything else was negative? So commodities were the winner in 2022, and fixed income bonds were the winner in 2008. So just interesting to see that a balanced portfolio does work, but some years there will be negative years, but in general, it smooths out the ride. Sectors are also the same sort of rotation. Some years sectors do really well, some years they do really poorly. Obviously, last year, technology was the screaming sector and communications. We saw in 2001 or 2001, two, where technology had lost 50%. So some years there's good, some years there's bad. Last year, obviously, utilities were the worst performing sector, but I could easily see a situation in the coming period of time where utilities are going to be maybe the top sector. In fact, I would imagine that everybody right now is using a lot of utilities with the cold weather, right? Stock market volatility has definitely been there. This is an index, volatility index. It's a measure of expectations of near-term volatility that's conveyed by S&P 500 stock option index prices. So we can see that COVID-19 was 2020 was definitely the big one. But lately you can see that volatility has waned and right now is at a very low point. That's good in some ways, but also worrisome in some ways, because oftentimes there's a calm before the storm. And I've got some other charts to show you here. Same thing with bond market. Obviously, the bond market was a lot more volatile as interest rates were rising, and it's settled down now too. In fact, I would expect that some of those bonds that were beat up so bad during that period of time are going to be in vogue again, and so those might be a positive investment for some folks if it makes sense. Value and growth, and a lot of people think, well, value is a good value. But it really has to do with what these companies do with their profits. So some companies take their profits and they reinvest them in research and development. Software companies, technology does that. Other companies like utilities, for instance, Southern Company, they take their profits and they pay those out in the form of dividends. So the dividend companies, we call those value, and the companies that reinvest their money to have a larger growth share, we call those growth. And they are different asset classes, and they sort of rotate in and out of favor. Sometimes they move together, sometimes they move in opposite directions. So we can see that really they were sort of moving together until right around, 2017, and they started splitting out. And so growth has taken over since then. And a lot of that has been because of technology. And there's probably a lot of the AI that's in there. AI is the big fad right now. And we see these fads come and go. And if you go all the way back to 1998, 1999, it looks very much the same. So that's another thing that we have to consider, because when we have that much growth, you can see we had a massive drop off, and it's recovered a good bit, but that's very volatile. And when you're retired, it makes for tough times, especially since for the last 2 years the S&P essentially is just back to where it started. And if you had been earning 5% or something along that time, you would have been better off, and without all that emotion. One of the biggest problems that we see kind of coming down the pike is commercial real estate, mainly office space. If you're in this building, you may notice that we are probably, I'm going to say 80% unoccupied, 80%. That doesn't mean that nobody's paying the rent, because I'm sure that they are, but there's a lot of people that are not here. There's a lot of empty space. And we are not the only building. We see that around the area here. I'm not so sure about downtown, but I hear that other cities in the country are experiencing a lot of the same vacancies. And this is not one of those things that hits you immediately, because people are still paying the rent. And then when their leases are up, that's when the rent stops, and they generally are having a hard time releasing that. So they're going to turn our building actually into an assisted living. At least that's the plan. So we have probably another year here. We've been here since 2000, so 24 years. And we have another 8 years to go, but they're going to cancel our lease and give us 6 months to get out, and then we're going to have to go somewhere else. But I think it'll be okay. Valuations, stock market valuations are definitely higher now than they were about a year ago. So that's what this chart is showing here: price to earnings ratios, price to book ratios, price to sales ratios, price to cash flow, dividend yield. All of those things are higher today than they were a year ago. And we can see that because after 2022, there was a big drop. Valuations looked better. And so 2023, you had a good market return. You know, essentially, if you had known exactly when to get out at the end of 2021 and had dropped, you know, and bought in exactly at the end of 2022, you know, and you're here today, then you know, that would have been a great ride. But if we had all bought Bitcoin at 5 cents, right, we wouldn't even probably be talking right now. That's the way it goes. So don't beat yourself up about not buying Bitcoin at 5 cents. Historical rates, you know, if we go all the way back to 1917, it looks different, but essentially in the 70s, you know, we're in Vietnam War, rates were pretty high. We had a lot of inflation there because we're printing a lot of money to fight the war. We had gold pegged to $35 up until 1971 when Nixon cut the window. And then obviously interest rates really jumped up there when Reagan put in Volcker. Volcker just raised rates incredibly to fight inflation, and eventually it did. We've been on this 42-year trend of reduced rates. Now, after the dot-com bust, you may remember rates dropped basically down to zero, and then after the 2008 bust, we were back down to zero. So there's, you know, zero is not a natural place for interest rates to be, and that would only be there because it was man-made. So there's been a lot of manipulation in the interest rate market, as there always in, and this is one of the things that happened, crashes the market and causes recessions, as I'll show you. Mortgage rates, obviously, with interest rates, those have come up, but recently they've come down a little bit. Corporate debt. This is something I want to talk about a little bit because, as I was mentioning earlier, all of these corporations out there on the S&P 500, 400, 600, whatever it is, if you're a public corporation, you're pretty much required by the market to have debt, whether you really even want to or not. A lot of them take the debt and do good things. A lot of them take the debt and just kind of float it. What has happened here is, you know, there's obviously a lot of debt out there, especially if you look at large caps, that's 1.3 trillion, mid caps, 1.2 trillion, 900 billion almost, and small caps. And this money is being loaned in form of bonds at the lower interest rates. And what's happening now is that as those bonds mature, and they're maturing basically every month, those bonds are being replaced by new bonds, and the newer bonds now have a higher interest rate. And in some cases, the interest rate is 3 times higher. So if you have profits and you have earnings, then you have to pay your debt, and now your debt is triple what it used to be. You can see the problem here. That cuts into your profit. So if it cuts into your profits, it cuts into your earnings drop, then your earnings per share drop, and then your share price drops. And that's why investors sell off when interest rates start going up, because they know that eventually that's going to cut into the debt service expense of these corporations, and it's going to reduce their profits and reduce their earnings, and thus their share price would likewise drop. But that hasn't happened yet, you see, because the earnings per share are still relatively good. They haven't dropped significantly, mainly because this doesn't happen immediately. It doesn't happen overnight. It takes months and sometimes a year, maybe 2 years for the interest rates to work their way through the bond market to really show themselves to the bottom line. And that's why we have this lag. And so right now, everybody's talking about a soft landing, and this is great. They were talking about exactly the same thing in 1999 and in 2000, and again in 2008. And it's never going to be, they're just never going to be able to foretell it. Human beings are not that intelligent. The Fed funds rate, so here we are, if we look at where we are now, which is 5.25, and then what we project, we're already talking about, at least they are already talking about lowering rates. So if we look at the federal governor, so the individual federal governor projections, federal open market committee members, and we can sort of see where they each plot these these little blue dots here. So each one of these little blue dots is each one of the governors sort of taking a vote guess about what they think the future is going to be like. So here's 23, 24. So in 2024 now, they're all saying that we're going to drop down to 4.6 is the average of what they're saying that we're going to drop. I just don't see that happening anytime real soon, because inflation is still there, and that I would be surprised if that actually ends up occurring in the next 6 months. So that's something that we obviously want to watch carefully. But what I want to talk about though is, what happened back with the 2008 drop. So here again is the Fed funds rate from 2005 to 2009. And I want you to see that, we were on a steady, pretty sharp increase on interest rates right there. And then in July of 2006, the Fed suddenly stopped. Well, why did the Fed stop? Well, they stopped because there was a market drop, a pretty significant market drop right there, and I'll show it to you in a second. But what I wanted you to point out is from July of 2006 all the way to essentially August of 2007, they didn't do anything. They didn't raise rates, they didn't lower rates, they didn't do anything. Okay, but then all of a sudden they reversed, and they reversed dramatically. In fact, they reversed all the way down to zero. Why did they do that? Well, you know the answer. The reason they did that is because there was a major market drop. So here was why the Fed paused. They paused because of this drop right here. And this is the NASDAQ. And the NASDAQ, has always been a little more volatile than the other two indices that we follow, which are the S&P and the Dow. But they paused right here, didn't do anything, didn't raise rates, didn't lower rates, but you see the market reversed and continued to what I call melt up. It kept going up even though prices were high and earnings ratios and price earnings ratios, were saying it didn't make sense. People were still buying in. But then all of a sudden, after this massive drop here, the Fed started lowering rates. And when they lowered rates here, we had another massive run up till we hit the all-time high. And then once we hit the all-time high, again, the Fed during this period of time was still dropping rates, then the market just collapsed. And we have false hope here, false hope here, false hope here, and then just finally, lost more than half. We went from 2,800 at the high to almost, say, around 1,300 there. That's a lot. A wild ride. So you can see that even though the Fed stopped, the damage had already been done. And even though the market went higher, the final drop had not yet occurred. And I believe that this is exactly where it's shaping up for us right now. I believe that we are right in this period where we've had this drop in 2022, excuse me, and then 2023 has been this run up. And this is what I expect 2024 or 2025 to look like. I really do. If we go back and we look at basically the last, 80 years or so of the Fed funds, all the way back to 1955, you can see these gray lines running vertically are recessions. So what happens is we have interest rate hikes, and then a quick reversal, and then a recession. Well, the reason that they reversed so quickly was because the market crashed. Then we reverse it, market gets off the ground again, interest rate hike, plateau for a very short time, quick reversal. Interest rate hikes, sharp reversal, sharp reversal, sharp reversal, point, sharp reversal, small plateau there in 2008, small plateau there in 2019, and then here we are again in 2024. Every time the thing peaks out, we end up having a drop. And by the one, there was one right here. That was 1987. For those of you that were in the market in 1987, you may remember that. That was a significant decline. There's not a gray line there because technically it wasn't a recession, because technically it didn't last for the required 20 months. So, according to this, we're now in interest rate red territory where we were, same place back in 2008 and again back in 1999. So I believe at this point we're just kind of waiting on the interest rate hikes to work their way through the bond market and everything else. Another problem, of course, as interest rates go up, is paying our debt. So now our debt is $33 trillion. I mean, it just doesn't even compute. But we're adding another 4 or 5 trillion every year, and we'll probably add another trillion just in interest. So you can see that it's almost a vertical line there. And of course, we're like a teenager with a credit card that, I guess we never see the bill. And so we just keep charging things without ever, thinking about having to pay this off. And I honestly don't know that we ever will or how. In most countries, when we get out of control like this, the currency collapses and they start with a new one. I know in Brazil, they've had that happen several times, and they'll go from one currency, and you had maybe 100,000 of cruzados, and now those 100,000 cruzados are going to be worth 5,000 of the real, the new thing. And so I know that in South America and in other countries around the world, they've had to replace their currency multiple times. And we all know what happened. And people didn't really want to talk about it, but it used to be like in Italy and in Greece before the euro. Like if you remember the lira, for instance, I mean, it was like 50,000 lira to buy a bottle of water, or 100,000 lira for a Coke. And at some point, the Italians just sort of dropped off, three of those zeros. And that worked for a couple of years. But then, like all those central banks, they just print money and massive inflation. And so for those countries down south, it worked for them to get on the euro because it took the printing press away from them. But for the poor country, or for the country, they're not poor, the rich countries up north who were like Germany and the Netherlands, who were being smart about their money and not inflating it, and like the Swiss. The Swiss aren't part of the euro, but the northern countries were usually a little bit better about not spending so much money. And now they've kind of gotten mixed in. They haven't they have gotten mixed in with those spenders down south, and they're experiencing massive inflation too. So it's all over the world at this point. Economic developments, well, unemployment rates obviously spiked a lot during COVID and have worked their way back down now. The thing that we need to remember about is that we get these numbers from the Bureau of Labor Statistics, and oftentimes they're not always what we believe them to be. In fact, we used to look at these differently. In fact, in 1980, we used to use the blue line. So the blue line would be the official unemployment rate back in the 1980 numbers. But we changed it in 1980, and then we changed it again in 1990. And so now the red line is what we're working with. So if we went back to probably the more honest numbers, we're closer to 25%. And, those are people who don't have full-time jobs. They are underemployed or part-time employed, or between jobs, or woefully unemployed or hopelessly unemployed. I mean, after you've been unemployed now for after a year, they just drop you off. They stop counting you. And so, they change the numbers. They change the formula when we don't like the numbers. Kind of the same thing with wage growth and inflation and everything else. But hopefully wages are growing. I certainly, something I think about with my own employees here, and it's, it puts pressure on me to increase their wages as well. This consumer price index, which is inflation, essentially the way we look at it. Again, we've changed this formula a couple of different times. So it went obviously way up, and the Fed has raised rates, and they are reducing the balance sheet. I'll give them that. And so inflation should be coming down. But inflation isn't just about, rates going up or dollars, or prices going up. It has to do with the value of dollars. And when you have more dollars in the system, the value of each dollar means less. And it's not necessarily about supply chain. It's not about the weather. And it's not about global warming. And it's not about anything else. It's just about you printed too many dollars, and each dollar is worth less. So all those other things impact prices as well. But you have to keep track of, when we're talking about inflation, what are we really talking about? Again, going back to the 1980 way we looked at inflation, we're closer to 12%. And if you've been out to lunch lately in any restaurants or even dinner, or you've been to the grocery store lately, I think you see that a box of cereal is now $7, just a regular box of cereal, $7. And you heard about the $16 value meal at McDonald's, $16 value meal. So, so inflation is real, and prices are not going to be going down. I mean, what we're trying to do now is just stop inflation from going up so much. We're trying to get prices to stop rising as fast. They're still rising, but hopefully they're not rising as fast, and that's what we're looking at here. But again, we changed the numbers in 1980, and we changed them again in 1990 because we didn't like what we saw. And that's the Bureau of Labor Statistics. And you can find these, you can follow these yourself. Just go to shadowstats.com. A guy there, John John, I can't remember his last name, but he's still tracking that. He used to work at the Bureau. Personal savings rates, um, well, not as good as I'd hoped. I remember back in the 90s that people had actually were pretty good at saving. And since the the new millennium, um, they're not much of a saver. So our moving average now is back down to, roughly 6.5%. The saving rate is about 4%. But with inflation, it's harder for people to save. It just is because things are just much more expensive. And I know around here, I hear complaints about rent all the time. Apparently, it's out of control. Consumer sentiment from this comes from the University of Michigan, and they survey a bunch of consumers, and this doesn't look great either. Because remember that 70% of our economy is spending, is consumer spending, and when consumers don't feel as good, they don't spend as much, and so it kind of has this self-actuating effect where if consumers don't feel good, they don't spend as much, and they haven't spent as much, and so stocks don't do as well, and the market doesn't do as well, their 401ks don't do as well, and then they don't feel as good, and so they don't spend as much, and it just keeps kind of going like that. Um, so I'm pretty negative myself, honestly. All the leading economic indicators are in the negative space, and we've seen, even back at the tech bubble, we're kind of approaching that. And I think this is going to originate in the tech system. We've seen where with AI and in the tech space, it's just blown up. And if you think about what happened back in the dot-com thing, the internet was kind of new, and all these dot-coms were coming along, and all this, we had web van, and all of a sudden everything could happen on the internet, and the internet was the conduit, but it was also the commodity. So people were buying internet stocks and going on the internet to buy those internet stocks, and it just went crazy like that. And I think that's starting to happen with AI. I mean, AI is in your life, and you don't even realize it half the time. Half the letters that you get from these big corporations are probably written by AI. I mean, if you haven't played with it, go on in there and play around with it. You would be surprised. Ask it some questions. Ask it how it feels about itself. What do you think about humans? How efficient are humans? The answers are interesting, to say the least. But in any event, currently, leading economic indicators are trending lower. The global stock market, I mean, again, if we go back over the last 2 years, we're just now back to where we were. I know that 2023 was gangbusters, but we really were just recovering ground that we had lost in 2022. So we haven't, nothing really new here. Emerging markets are still down 12%. Developed markets in the United States are roughly flat for the last 2 years, and we'll see where the next few months lead us. Forecasts are not necessarily good, especially if you live in Russia. This gold color here is for 2023, and well, now we're in 2024. So what does that tell us? Well, it just tells us that the trend is trending down, and with interest rates higher, that's just always going to happen because it costs more to finance debt, and when you have higher debt service charges, you have less earnings, and that's just math. Oil prices have been relatively stable, surprisingly, during all of the wars and crises we've had around the country, around the world, in Russia and Ukraine, and now in the Middle East again. So hopefully those will continue to remain stable. Economic activity globally has been trending down as well. So, it was pretty gangbusters in 2021, 2022. We all took a hit. 2023, market came back a good bit, but that doesn't mean businesses, activity has actually recovered. So that's another forward-looking sort of negative trend that we need to watch. Central bank balance sheets have all come down a good bit, except for Japan. The European Central Bank and obviously us, when these numbers come down, that means money is worth more. They've printed less. When those numbers go up, they've printed more and money is worth less. But if you look, I mean, we've essentially doubled the amount of money since 2008. So, and if you look, I mean, basically the prices of everything are roughly twice. I mean, a value meal was $8 and now it's 16 since that time. So I'm not laughing because it's funny. I mean, what else can you do? You have to laugh or cry. Policy rates. Now, this again, the central bank, Fed Bank, the Bank of England, all of them have been raising rates, and just almost like they're completely in concert together. And it's interesting because you only hear about what the Fed does. You don't really hear about what other central banks do, but it certainly does look like they're coordinating their efforts, doesn't it? And I can tell you they absolutely are, because what they do is they meet in this place called the Bank of International Settlements. And the Bank of International Settlements is in Basel, Switzerland. And there's nothing evil about it. It was set up during after World War I, when they were trying to fund reparations to Germany to help Germany rebuild. So basically, Europe, England and France mainly, owed a lot of money to the United States. And then Germany owed a lot of reparations to England and mainly France. And France didn't want Reichsmarks. They wanted coal, gold, hard assets. So to get those hard assets, the United States would loan money to Germany so that Germany could then buy those assets and supply them to France mainly. And then France would somehow turn around and then pay money back to the United States on those loans. So it was kind of a big cycle. Well, after World War I was over, the bank never went away, and we had World War II. And then after that, it kind of made sense to keep it in place. And then now, fast forward, 50 years, it is a place where all the central bankers fly in together, mostly in secret, and they meet totally in secret, and they supposedly coordinate their efforts for the benefit of all humanity. That's the storyline. So I've got other options and other ideas. But hey, if you want to find out more about that, there's a great book called The Tower of Basel by Adam Labor here. And I've read it. Pretty interesting. Some things I didn't know. But if you didn't know about the Bank of International Settlements, if you haven't learned anything else today, you've learned that. I appreciate all of you sticking in there with me, and we're going to send these to you. And if there's anything I can do to help you, please reach out. Have a great day. Thanks very much.